All right, so let's pick up where we left off. This is part 2. What are some of the basic assumptions underlying principles? Well, we were talking about the economic entity assumption. Each business is its own economic entity. One business separate from its owners. All right, and that's what we were talking about in the sense of that business exists, business's financial statements exist by itself, meaning that the owner's costs, expenses should not be included in the financial statements of the business. Okay, let's move on from here. The cost principle. I believe your book refers to it as the cost principle. When I was in school, we referred to it as the historic cost principle, which I think makes a little bit more sense to remember exactly what it means. What the historic cost principle says is that we record assets for what we purchase them for. We acquire assets, the acquired assets are recorded at the original cost. Oops. What that means is, let's say I bought a piece of land for $10,000. Now that land's worth $100,000. I would still have it recorded on my books for the original $10,000 I purchased it for. Doesn't matter if it's appraised at $100,000. Doesn't matter if I can get, $100,000 if I sell it tomorrow. Doesn't matter that if the property taxes are appraised at $80,000. Doesn't matter. It's what you originally paid for that asset is what you put on your books for, because that is the most objective data. All right. Going concern assumption says that the business is going to be considered to continue running for the foreseeable future. You have no reason to believe otherwise. If you do have reason to believe otherwise, like the business is going under for some reason, they're being sued, they're just a massive liability, whatever, then that's not the going concern assumption. You would have to tell that to the users of the financial statements. All right, monetary unit assumption. I always get a kick out of this one. Transactions are recorded in dollars. All right. So the idea here is simply that transactions are recorded in dollars. I don't know, maybe somebody did it in rupees or something at some point, but, reported their financial statements in fictitious numbers. But the idea is that transactions are recorded in dollars. I don't know why it has to be said, but apparently it does. Okay, so these are some of the basic assumptions underlying principles of accounting, financial accounting, and accounting statements. All right, so let's talk about ethics in accounting. And we get into a whole chapter where we talk about it a lot. I want to say it's chapter 7. But for now, we'll just hit the highlights. Ethics in accounting wasn't such a, it sounds terrible, wasn't such a big deal, but it became a much bigger deal. There's always fraud, there's always things that happen, but it became a much bigger deal when Enron came into play, and that was the early 2000s. What happened was Enron put out bad financial information, and when I mean bad financial information, I mean really bad financial information out to the users, right? To the stakeholders, to the people that we talked about earlier that are interested in looking at your financial statements. They just made up their own accounting rules, pretty much significantly. And Enron was huge. It was a huge company. When I was using examples earlier, I was saying Microsoft. Well, Enron was, also one of those ridiculously large companies, and they dealt in many different areas. One of them was energy, communications, things like that. Anyway, so they had bad financial information that they put out there to the investors and the creditors. And the idea is that the auditors, right, the CPA firms, when you're a public company, you are required to have your financial statements audited at least once a year. Okay, meaning that they go through and they make sure that you're following the accounting rules, you're applying GAAP properly, and so on. And these are the auditors. The companies pay the auditors to come in and do this work for them. And as I said, they're CPA firms. Well, those auditors are supposed to catch when there's bad financial information, because their whole job is to protect the investors and creditors. Because the auditors are putting basically a seal of approval on the financial statements and saying, yes, you can rely on these. We've audited them, and they are fairly representative of the business, and so on. So, those financial statements are put out there by the companies. The auditors go out and they audit them, put their stamp of approval on them, then the investors and creditors can rely on them, presumably. Unless, of course, Enron is paying the auditors. So that's when it kind of all falls apart. When the auditors are in on the scheme with them, and because they're making money, that's not exactly the most ethical behavior. Okay, so it's not like every auditor is in on something. It was really one team of auditors, one team of partners that was in on it. But unfortunately, it was a huge deal. It took out a lot of people, a lot of people's investments and savings. I mean, think about how huge it would be if something like Microsoft or Apple went down, right? Everybody's financial portfolios would plummet and the market would completely, freak out. So the idea was that people didn't want to invest anymore because they were afraid they couldn't rely on these auditors. And there was a couple other things that happened along the way with Enron. That was really your big one. But what they did was they put into place something called the Sarbanes-Oxley Act. Okay, SOX it's referred to as, and it was put out in 2002. And the reason for putting out this act was because they wanted to restore investor confidence, right? They wanted these people to put their money back in the market. So what they did is, there were a lot of things that came along with Sarbanes-Oxley Act, and we'll talk about them more, as I said, in the future. But one of the major things they put into play was jail time for executives. All right, when something like this happens, before the Sarbanes-Oxley Act, maybe they went to jail, maybe they just lost their job. Now there's actual jail time was put into play, actually stated for the executives who committed the fraud. Also, they put in kind of an oversight board. The accounting firms the CPA firms were always thought of as, the most ethical people. So they didn't have to, you didn't have to question their ethics. Well, apparently you did. So what they did was they put a whole board over the top of them called the PCAOB, the Public Company Accounting Oversight Board. Basically, it's kind of like police for CPA firms. They're the ones that they go in and they check, right? They spot check the auditing firms, the CPA firms now. Before CPA firms would check each other, they would have something called peer review. And they would look at each other's audits and make sure, yes, they're following all the rules, they're auditing, they're doing a good job, and so on. Well, I kind of took that away. It still exists, but the idea is now you have this overarching board over the CPA firms looking down, checking to make sure that the auditors are doing their job properly. Okay, so that was new. All right, so that's it for that topic. Like I said, this chapter is a lot of little hit and miss. There's not a great flow in this chapter. All right, accounting careers. You heard me saying it before. Public accounting is is financial statements, right? Producing financial reports, producing them for the world. Those are your CPA firms, all right? CPA stands for Certified Public Accountant. Get it? Public. They do auditing, as I said. They also prepare tax returns. That's probably the way you hear most of the time when you think about CPAs, is they're preparing people's taxes. Well, they do a lot more than that. They audit, as I said. They do taxes. They do consulting work. They do forensic accounting, right? I want to say there's a whole This Way to CPA. There's a link in your Canvas that talks about all the different types of accounting careers that could be out there. So that's when you talk about public accounting. These are the kind of things you're thinking about. When you're talking about private accounting, that's usually you're working within industry. You're working for business or something like that. So you do still care about financial reporting because you actually have to produce the reports that then the public firms come in and audit. So your job is to do all the journal entries, do all the transactions, do all the work that leads up to the financial statements, produce the financial statements, get them ready to be submitted to the world, and then the public firms come in and audit them and make sure they look good and that they're following GAAP and all the things that they do. And then they're allowed to be released to the world. Okay? Very often, they're called management accountants. All right? Management accountants, I don't have the words in here, but management accountants also have their own certification. It's called a CMA, which is Certified Managerial Accountant. Okay, CPA is probably what you've heard of more, but the CMA is also a very important designation as well. Management accountants do things like, how much does it cost to make a product? How much should we sell something for? How many products do we need to sell to break even? All right, this is your managerial accounting that we talked about earlier. You also see in private accounting internal auditors. They're a team within a business that goes from area to area to make sure that the rules are being followed. So it's like their own internal auditors, their own set of people that they have trying to make sure that a company is doing the right thing in all of its different areas of its business. And most larger companies are going to have internal auditors. Okay. All right. What is profit? Profit is revenues, which is the amount earned from selling products or services. Right? That's the amount you earn doing your job, revenues, minus any expenses to earn that revenue. All right, the cost of resources used to get the revenue. So this is the money you earn, and these are the costs to earn that money, right? Like if you have to have employees, that's an expense. If you have to pay for property taxes because you need it on your building or you need to pay rent, that's an expense. You can't, make revenue. You can't earn money if you have no place, if you don't have a place to operate from, right? So revenues are the money that you earn doing your job, and the expenses are the costs of earning that revenue. One from the other, anything you have left over is profit. You also hear the words net income, you'll hear earnings, all of those things are the same basic idea, right? All of your revenues, all the money you earn minus all the costs to earn it, anything that's left over, hopefully a positive number, it leaves you with a profit, okay? Okay, so I think I'm going to stop there, and we'll go on to video 3.